In this video, we are looking at the Dallas rental market for multifamily properties, the Dallas Metro Statistical Area. But you're going to want to stay tuned to the end of this video because I get a lot of people that say Collin County is the darling of the Metro Statistical Area, or what they call the Dallas Metroplex. So you can't compare Collin County because it's going to prop the whole market up. Well, we're going to separate out at the end of this video Collin County so that we only look at the Collin County data for conventional apartments, and we'll compare the two and see if Collin County is propping it up or maybe even dragging it down, or if it's similar data. I have not looked at the data, so I don't know, but we'll see what it says. So as usual, let's go to our filters and see what we are excluding. So we're excluding all corporate, all military, all senior, and all vacation. And we are including only market and market affordable, so that we are just looking at conventional apartments. If we go to location, you can see that we are at market, metro markets, and the Dallas-Fort Worth Metroplex, or Dallas-Fort Worth MSA. All right, and as I mentioned, we will break out Collin County, and we will take a look at Collin County at the end of this video. But first, let's go look at the analytics for all Class A, B, and C properties for the Dallas MSA. So here is our supply snapshot. We can see that we have 5,915 properties, totaling 831,190 units. There are still 37,886 units under construction, and oh boy, we have only delivered 2,115 units in the last 12 months, where the prior period, so in 2021, there were 44,528 units delivered. In 22, there were only 2,115 units delivered. And I can see that the deliveries were quite strong in 2022 because our vacancy has ticked up from 6% to 8.2%, but we'll see what the data shows us. Again, this is for all three asset classes, A, B, and C. We can see that we have a year-over-year increase in market rent of 3.7%. We'll look and see what the quarter-over-quarter data shows us. Let's scroll down here and see where we are on our long-term occupancy average. So 91.5 is the long-term occupancy average for the Dallas MSA, and it is currently sitting at 91.77. So it is literally right on the long-term occupancy average line. So it is transitioning from oversupply to recession, but it's not there yet. Still has a little bit to go, but we'll see what the data shows us and see if it's the A's, the B's, or the C's, or a combination of all three that's dragging this market down. So let's go look at the data. So here is the data for all three asset classes. Remember, we do not look at asking rent. That's what you can go to apartments.com and see, or Rent-A-Meter or anything like that, which is why I do not use those tools. We don't care what the ownership is asking. We care what they are receiving, and that is effective rent. So if we look at first quarter of 2022, we can see that it was $1,479, went up to $1,532 in Q2, and then the downtrend started. So like all the rest of the markets we've seen, Dallas is in a rent decline situation, even though there are jobs moving to this and there are people moving to this area every single day. But what the renters are basically saying here is that we can no longer afford these rents. And I think the data is going to show us that. So that being said, let's see what our deliveries and absorption tells us, so that we can see that in the first quarter of 2022, we delivered 4,369 units, but we only absorbed 1,970, so less than 50%. That is not good. We like to see 80% or more to stay stabilized in the market for rents. Then we delivered another 5,135, but only delivered 2,911. What does this mean? So this means that new construction delivered 4,369 units, then another 5,135 units. That means that about 10,000 or 9,500 units went vacant because they were delivered to the marketplace without renters. And that in that same time period, in those 2 quarters, only about, let's just call this 4,900 absorbed. So about 50% actually rented those vacant units. So about 4,800 units went vacant in the market. Then we delivered an additional vacancy of 8,723 units, and it only absorbed 32. So now you're about 4,900, 4,800 vacant here. Now we're 13,000 vacant, and then another 3,928, so another 4,000. So now we're somewhere around 16 to 17,000 vacant, and now add another 2,260 to that vacancy. And you can see why vacancy has increased and occupancy has decreased each quarter of this market, which explains the downturn in rents, demand versus supply. Even though people are moving to this market, as I said, the renters have said, this is it. We can't pay these rents anymore. We know they live there because people are moving there every single day. They just cannot pay these rents anymore, so they are starting to double and triple up. And they're telling the ownership, stop raising these rents. We're now going to lease together, which affects our demand. But let's see which one's dragging it down, A's, B's, or C's, or if it's a combination of all 3. So let's go look at the A's first. So here is our Class A data. We can see that we have 834 properties totaling 259,674 units. We're looking at effective rent. So we started at 1,816 a month, went up to 1,889, and then the downtrend started. As a matter of fact, we are lower in the 4th quarter of 2022 than they were in the 1st quarter. Just about every single broker I saw that was putting OMs out in the Dallas Metroplex was saying that there was room for increases in rents, that rent was increasing on a year-over-year basis. That's the key, folks. Yes, it was increasing on a year-over-year basis, but what they're not telling you is that quarter-over-quarter, these rents are dropping like a rock. All right, so let's scroll over and see what deliveries and absorption tells us. So in the Class A space, it took 2,271 deliveries, so 2,271 units went vacant in the 1st quarter and absorbed 1,958. Not bad. Okay, that's good absorption. 2,234 and more than what was delivered was absorbed. So we're just about full absorption here, 100% from what was delivered. But here's where things start to go awry. So now, 3rd quarter, 3,707 delivered and only 1,106 absorbed. All right, so we got an additional 2,600 units vacant in the market, and then another 1,730 go vacant with another 269 going vacant. So we've definitely slowed and started to go backwards in our deliveries between the 3rd and 4th quarter of 2022, which explains the downturn in rents. All right, so that's the Class A market. This is definitely not the one that is holding the market back. Let's see what the Class Bs look like. So here's the Class B data. Again, we'll just be looking at effective rent. There are 1,826 properties in the Class B space, 360,219 units. Our effective rent, the Class Bs started at $1,422 in the 1st quarter, went up to $1,471, and then down to $1,459, and then down to $1,440. So small downtrend, but downtrend nonetheless. But yet we can see that vacancy is increasing a lot faster than the rents are going down. This is telling me that the ownership may be holding these rents back, even though demand is saying they need to go further down. But let's go take a look at deliveries versus absorption and see what it tells us. Okay, so we delivered 2,096 in the 1st quarter, only absorbed 839. That's not good. 2,901 delivered and only 1065 absorbed. Okay, so definitely have slowing to negative absorption in the Class B space. A lot more prevalent than in the Class A's. So we can see that 5,016 were delivered and another 2,198. So 7,200 units delivered, and 200 more units went vacant during that same time. So we definitely have a slowing to negative absorption in the Bs. The Bs definitely appear to be holding this market back. And we've gone from 93.9% occupancy to 91.2%. And that is going to continue to go down as there's still 19,545 units in this asset class to be delivered, which means there was an additional 19,000, because remember we had 38,000 in total left under construction. So between the Class A and B space, even though we're trending negatively in absorption, people are moving out of the rental market, we still have 38,000 total units to deliver. This is not a good sign for Dallas, no matter how you look at it. So we know the A's and B's are starting to trend down with absorption and going negative. Let's see what the C's are telling us. So here is our Class C data. We can see that we have 2,676 properties totaling 209,770 units, 777 units. We currently are looking at effective rent, and in the first quarter of 2022, rents were $11.21 a month. Went up to $11.55, went up to $11.65, went up to $11.70. Now, if we look at vacancy, we can see that vacancy has increased, gone from 4.6 to 6.7, a 2.1% increase in vacancy, yet the rents are continuing to increase. This is not good. This is saying that the ownership and management companies are just arbitrarily raising rents because they believe they can. Now, I'm going to give them a slight benefit of the doubt, because at 6.7% vacancy, that's still kind of low vacancy. Although the negative absorption that I'm sure we're going to see is saying that more people are moving out of this market than are renting the market, which means these rents are going to trend down. All right. They are not going to continue on this track. They will definitely trend downward. Let's see what the absorption shows us. And as suspected, the absorption is negative all the way across the board. So there is no reason for those units to be increasing in rents other than the fact that the market is somewhere around 92% occupancy long-term average. So they could be working towards getting to that long-term occupancy average and are raising rents until they get there. That may be they might be anticipating an 8% vacancy as a stabilized vacancy, in which case they're justified to do so. But the residents are definitely telling them, we are not going to pay these rents anymore. And they are starting to move out of the rental market, which means they're doubling and tripling up, because we know jobs are coming. We know people are moving into the area. So that's definitely an indication of doubling and tripling. We can see that we have some under construction units here. Take these with a grain of salt. That means these are probably in bad areas. CoStar will include under construction in Class C- areas as a Class C property to be delivered, when in actuality, it will be a Class B property delivered in a C- area. All right. So that is the Dallas MSA. It is definitely confirmed that it is sitting on the long-term occupancy average in the market cycle between oversupply and recession. It's only going to take a little bit more, maybe 1 or 2 more quarters, and Dallas in the multifamily rental market for conventional apartments will go into the recession phase and start to enter that down track, especially since there are still 38,000 units to deliver in this market. And what's even crazier is there's still developers looking for land to continue to build even more units, even though we're showing negative absorption in the fourth quarter on all 3 asset classes. Now, I'm going to pause this video and I'm going to change to just Collin County, and let's see what Collin County looks like for the overall asset classes A, B, and C. So hold on real quick. So here is Collin County, Texas. You can see that it is in the Dallas Metroplex, or the Dallas Metro Statistical Area. You can see where Dallas and Fort Worth is here. And so we are in what they consider to be the affluent market for the Dallas MSA. And you can see we're in county, state is Texas, Collin, Texas, or Collin County, Texas. Filters have not changed. If we go back over to our filters, we can see that we are still excluding corporate and military, senior, and vacation, and we are still only including market and market affordable, and we don't have any of the asset classes selected, so we are looking at all three asset classes, A, B, and C. So let's see what the analytics tell us. So it is showing us, with our supply snapshot, a very similar story to the Dallas MSA. So we can see there are 452 properties in Collin County, 113,757 units. There are still 7,661 units under construction. They have only absorbed 1,481 over the last 12 months, where in the previous 12 months in 2021, they absorbed 7,817. In 2022, they only absorbed 1,481. And it's indicative of the vacancy, where it was 5.9 and has gone all the way up to 8.5. This is the reason, if we go down to our long-term occupancy average, we can see that the long-term occupancy average for Collin County is 92.4, and it is currently sitting at 91.49. This is showing that Collin County is on the south side of that long-term occupancy average, starting its transition a little faster into recession for multifamily conventional apartments than the entire MSA. So I'd argue that Collin County is actually dragging down the MSA, not propping it up. But let's see what the data shows us for all three asset classes. So here is the data. Again, just effective rent. We can see that the rent started at $1,670, went up to $1,742, and then the downtrend started, as we saw with Dallas, down to $1,726, down to $1,675. If we look at the vacancy, we can see the vacancy was at 5.6 in the first quarter of 2022 and finished the year at 8.1%. Right? So that tells me that this market is not absorbing their units. So if we go over to deliveries and absorption, we can see none delivered, but 572 absorbed in the first quarter. That's good. Then 1343 delivered, 1172 absorbed. Again, over 80%, so that's good. But here's where the trouble starts, just like it did in the whole MSA. In the third quarter, 2678 delivered, only 222 absorbed. Then another 186 went vacant, and an additional 278 went vacant. So we can see that from second quarter 2022 to third quarter 2022 was when the Dallas transition started. And once again, if you're only paying attention to the broker and you're looking at a year-over-year increase in rents, which it will show you whether you are in the MSA or whether you are in the Collin County area. Remember, the MSA, I think, was 3.1 or 3.2% rent growth. Collin County is 2.7% rent growth. That's year over year, not quarter over quarter. All right. So what does this say for the Dallas Metro Statistical Area? For all of you that have purchased in the last 3 years and you are still holding on to these properties, hold on to your hats. It's going to be a rough ride. These rents are going to continue downward. The cycle has picked up speed. It is definitely trending down. It is going to continue to trend down. With all the deliveries left to deliver to the market, I would not be surprised to see a 20% decrease in rents in this market. So Dallas, you're in a bit of trouble. You're not in recession yet, but you are definitely right on that line heading in that direction. So that concludes the Dallas rental market for multifamily properties, including Collin County. Broke out to see how they compared. Tomorrow, we will be looking at Milwaukee, Wisconsin. I will see you guys tomorrow.